There's a checkout page open on your laptop, a business credit card application. You've filled in your name, your address, your social security number. Then you hit the field that says business name, and you freeze because you don't have a business. Not really. You've got a side hustle. Maybe you sell things online. Maybe you do freelance work. Maybe you're thinking about starting something, but haven't yet. And now you're staring at this form, wondering if what you're about to do is legal, illegal, or somewhere in that gray zone Americans have gotten very comfortable living in. Here's what most people don't know. You can get a business credit card without a registered business, without a business bank account, without employees, and in many cases, without making a single dollar in revenue. And it's completely legal. The banks know. They expect it. In fact, they've designed the system specifically for people like you. But here's the part that should make you nervous. Once you have that card, you're not just a consumer anymore. You've crossed into a different category of borrower. Different rules, different protections, different consequences when things go wrong. And most people who apply have no idea what they just signed up for. This is the story of how millions of Americans stumbled into a parallel credit system that was supposed to be for entrepreneurs and businesses, but has quietly become something else entirely. A system where the definition of business has been stretched so thin it barely means anything. Where the line between personal and professional debt has blurred beyond recognition, and where the credit card companies are making a calculated bet that you won't read the fine print. Let's start with the obvious question. What actually qualifies as a business in America? The technical answer is simple. If you're doing anything with the intent to make a profit, you're a business. Sell a couch on Facebook Marketplace once? That's technically a business. Mow your neighbor's lawn for $50? Business. Walk someone's dog? Business. The IRS doesn't care how small it is, how irregular it is, or whether you're any good at it. Intent is what matters. This is where the term sole proprietor comes in. It sounds official. It sounds like paperwork and filing fees and trips to government offices. But a sole proprietorship isn't a legal structure you create. It's just the default state of existence for anyone doing business-like activities as an individual. You don't register as one. You don't incorporate. You just are one. The moment you do something for money outside of a traditional job, congratulations, you're a sole proprietor. Here's the uncomfortable part. The banks issuing business credit cards know this. They've known it for decades, and instead of creating barriers, they've systematically removed them. In the early 2000s, getting a business credit card required proof. Tax returns showing business income, an EIN, which is like a social security number for your business, bank statements, revenue documentation. The process was designed to filter out casual applicants and focus on established businesses. But then something shifted. The credit card industry realized they were leaving money on the table. There were millions of Americans doing side work, freelancing, running tiny online stores, driving for rideshare apps, all of them spending money on their activities, and they were using personal credit cards to do it. Personal cards with lower limits, fewer rewards, and consumer protection laws that actually cost the banks money to comply with. So, the industry made a choice: open the floodgates. Today, when you apply for a business credit card from Chase, American Express, Bank of America, or Capital One, the application asks for your business name. But here's what they don't tell you up front. You can use your own legal name: John Smith, Sarah Johnson, whatever is on your driver's license. That counts as a business name for a sole proprietor. They ask for your business structure. Sole proprietorship is right there in the drop-down menu. They ask for your tax ID. You can use your social security number instead of an EIN. They ask for your business revenue. And here's where it gets interesting. There's no verification. You estimate your annual revenue. You estimate how long you've been in business. You submit the application. And in many cases, you're approved in under 60 seconds. No tax returns, no bank statements, no proof of anything. The entire system runs on trust. Or, more accurately, it runs on the assumption that most people won't commit fraud, and that the ones who do will eventually pay their debts anyway, because it's attached to their personal credit score. Let's walk through what happens when someone applies. A real scenario. Meet Alex. Alex works a full-time job in marketing, makes about $70,000 a year, and has started doing some freelance graphic design on the side. Made about $4,000 last year. Spent maybe $2,000 on a new laptop and some software subscriptions. Alex sees an offer for the Chase Inc. Business Preferred Card. 80,000 bonus points after spending 5,000 in 3 months. Travel credits, phone insurance, no annual fee the first year. Alex opens the application. Name, address, social security number. Business name, Alex types in Alex Morgan Design. No LLC, no registration, just a name. Business structure, sole proprietorship. Tax ID, social security number. Years in business? Alex started freelancing about 14 months ago, so let's call it 1 year. Estimated annual revenue? Well, made $4,000 last year, expecting to make maybe $6,000 this year. Alex types in $6,000. Submit. Approved. $7,000 credit limit. The entire process took 4 minutes. Alex now has a business credit card, and here's what just changed. First, this account won't show up on Alex's personal credit report. Business cards typically aren't reported to consumer credit bureaus unless there's a delinquency. That means the $7,000 credit line doesn't count toward Alex's total available credit when applying for a mortgage or a car loan. It's invisible. This is actually one of the main reasons people get business cards, even when they barely have a business. Second, Alex is now subject to the Card Act, except not really. The Credit Card Accountability, Responsibility, and Disclosure Act, passed in 2009, was the biggest consumer protection reform in credit card history. It limited fees, restricted interest rate increases, required clear disclosure of terms, but it specifically exempted business credit cards. The logic was that business owners are sophisticated borrowers who understand what they're signing. They don't need the same protections as regular consumers. But Alex isn't a sophisticated business owner. Alex is a marketing employee with a side hustle, and Alex just waived a bunch of protections without realizing it. The credit card company can now raise Alex's interest rate at any time, for any reason, with just 15 days' notice. They can change terms mid-agreement. They can impose fees that would be illegal on a consumer card. And if Alex runs into financial trouble, the bank can pursue Alex's personal assets, because sole proprietorships don't have liability protection. But Alex doesn't know any of this. Alex is thinking about those 80,000 points. Here's the math the credit card companies are doing. They're not stupid. They know a significant percentage of business card applicants are just consumers gaming the system for rewards. They know the stated revenue numbers are inflated or made up. They know many of these businesses will never generate meaningful income, and they don't care, because the rewards are funded by merchant fees. Every time you swipe that card, the business you're buying from pays a fee to the credit card network, usually between 2 and 3% of the transaction. Business cards often have higher merchant fees than consumer cards, so the more you spend, the more the credit card company makes, regardless of whether you're actually running a business. The bonus points? They're not free. They're a marketing cost. Chase isn't giving you 80,000 points out of generosity. They're buying a customer who they expect will spend hundreds of thousands of dollars over the lifetime of that card relationship. If you spend $5,000 to get the bonus, then never use the card again, they lose money on you. But most people don't do that. Most people start using that card for everyday purchases because the rewards are better than their consumer cards, and suddenly, that card becomes part of their financial identity. The average American household carries about $5,000 in credit card debt. The average business credit card holder carries about $12,000. Some of that is legitimate business expenses, but a lot of it is personal spending that got reclassified as business spending because the rewards were better and the credit line was higher. And here's the trap. When you mix personal and business expenses on a business credit card, you create a documentation nightmare. If you ever get audited by the IRS, you need to prove which expenses were legitimately for business. If you can't, those expenses aren't deductible. But you've already lost the consumer protections. You're in the worst of both worlds. The credit card companies know this too, and they still approve millions of these applications every year. Let's talk about what happens at scale. Because this isn't about one person with a side hustle. This is about millions of Americans who have collectively borrowed billions of dollars under the premise of business ownership. In 2023, there were roughly 32 million small businesses in America. Sounds impressive, until you realize that about 25 million of those are sole proprietorships with no employees. One-person operations, many of them generating less than $10,000 a year in revenue, some generating zero. But those 25 million sole proprietors have access to the same business credit cards as established companies with payroll and offices and multiple revenue streams. Same application process, same approval algorithms, same credit limits in many cases. The business credit card market is now worth about $700 billion in outstanding balances. That's smaller than the consumer credit card market, which is over $1 trillion, but it's growing faster, much faster. because the barriers to entry have essentially vanished. And here's where it gets weird. Some people have figured out how to exploit this system in ways the banks never intended. There are entire online communities dedicated to churning business credit cards. Open a card, hit the minimum spend for the bonus, downgrade or close the card before the annual fee hits. Repeat with a different bank. Some people have 20 or 30 business cards. They manufacture spending by buying Visa gift cards, using them to pay bills, then paying off the cards. They're not running businesses. They're running reward optimization schemes. The banks could stop this. They could require documentation. They could verify revenue. They could limit approvals. But they don't, because even the churners are profitable. The merchant fees alone cover the cost of the rewards, and some percentage of churners will eventually become regular users who carry balances and pay interest. It's a calculated risk, and so far, it's paying off. But let's zoom out. What does it mean when millions of people are walking around with business credit cards for businesses that barely exist? On one level, it's democratizing access to credit. Someone who wants to start a real business but doesn't have capital can get a business credit card, use it to fund early expenses, and bootstrap their way to profitability. This is actually how a lot of small businesses start. Founder puts expenses on credit cards, makes just enough revenue to cover minimums, then gradually pays down the debt as the business grows. It's risky, but it works. On another level, it's creating a shadow economy of debt that's not being tracked the same way consumer debt is. Because business credit cards don't show up on personal credit reports unless there's a default, there's no easy way to measure how much debt individuals are actually carrying. You could have someone with a 750 credit score and $50,000 in business credit card debt, and none of that debt is visible to a mortgage lender until they miss a payment. The credit reporting agencies know this is a problem. Lenders know this is a problem. But there's no regulatory push to change it because the system is technically working. Default rates on business credit cards are actually lower than consumer cards, partly because business card users tend to have better credit scores, partly because the consequences of default are more severe since there's no Card Act protection. But there's a darker possibility. What happens during a recession? In 2008, consumer credit card defaults spiked because people lost their jobs and couldn't make payments. But the Card Act wasn't in place yet, and banks were able to raise interest rates and fees aggressively, which made the problem worse. After the reforms, consumer credit cards became more stable. Banks couldn't jack up rates arbitrarily. Consumers had more predictable terms. Business credit cards don't have those protections. If there's another major economic downturn and millions of people with business cards start missing payments, banks can respond aggressively. Rate increases, immediate account closures, pursuit of personal assets. And because these cards don't show up on credit reports until there's a problem, the damage could spread quickly and invisibly. Nobody knows how bad it could get, because this system has never been stress tested at scale. Here's the other uncomfortable truth. The IRS is watching. If you have a business credit card, you're implicitly claiming you have a business. And if you have a business, you're supposed to report income and expenses. Even if you're a sole proprietor using your Social Security number, you're required to file a Schedule C with your tax return, showing your business profit or loss. Most people who get business cards for side hustles are doing this correctly. They report their income, deduct their expenses, pay taxes on the net, but some aren't. Some people get business cards, use them for personal spending, and claim business deductions for things that aren't actually business expenses. That's tax fraud. And while the IRS doesn't have the resources to audit everyone, they're increasingly using algorithms to flag returns that show suspiciously high business expenses relative to income. If you report $8,000 in business revenue and $15,000 in business expenses, that's a $7,000 loss. Losses are allowed, especially in the first few years of a business. But if you're showing losses year after year while maintaining a full-time job, the IRS might decide your business is actually a hobby, and hobby expenses aren't deductible. The penalty for getting this wrong isn't just paying back taxes. It's paying back taxes plus interest plus penalties. And if the IRS determines you intentionally misrepresented your expenses, that's fraud, which comes with much steeper consequences. The credit card companies aren't responsible for any of this. They're not tax advisors. They don't verify how you use the card. That's between you and the IRS. But by making business cards so easy to get, they've created a situation where millions of people are operating in a space they don't fully understand, with tax obligations they might not be meeting. So, what's the move here? Is this a system you should participate in? The honest answer is, it depends on what you're actually doing. If you have a legitimate business, even a small one, business credit cards make sense. Better rewards, higher limits, separation of personal and business expenses, and access to features like employee cards and expense tracking tools. The lack of Card Act protection is a trade-off, but it's one you can manage if you're disciplined about payments. If you're mostly just chasing rewards, you're playing a game the bank's designed for you to play. You'll probably come out ahead if you're strategic about it. Hit the bonuses. Use the cards for categories where they offer the best rewards. Pay off the balance every month. The banks are fine with this because they're making money on merchant fees. Just understand that you've given up consumer protections, and if something goes wrong, you have fewer options. If you're thinking about using a business credit card to fund personal spending because you can't get approved for more consumer credit, stop. That's a red flag. You're taking on debt without protection, under terms that can change at any time. And when you mix personal and business spending, you create problems with both your credit profile and your taxes. The system works when people play by the rules, even if those rules are loose. It breaks when people treat business credit cards as unlimited personal slush funds. Here's what keeps me up at night about all this. The financial system has a habit of creating tools for one purpose, then discovering they're being used for another, and then pretending everything is fine until it isn't. Subprime mortgages were supposed to help people with bad credit buy homes. They turned into a vehicle for speculation and fraud. Margin trading was supposed to let investors leverage their portfolios. It contributed to the 1929 crash. Student loans were supposed to make college accessible. They've created a $1 trillion debt crisis. Business credit cards were supposed to help entrepreneurs manage cash flow and build credit separate from their personal finances. And they do that. But they've also become something else, a way for consumers to access more credit with fewer protections, a way to manufacture rewards through manufactured spending, a way to blur the line between personal and professional in ways that create risk nobody is fully measuring. The banks will tell you this is financial innovation, giving access to credit for people who wouldn't have qualified under old rules, empowering the gig economy, supporting entrepreneurship, and there's truth to that. Millions of people have started real businesses using these cards. Millions more have earned rewards that have genuinely improved their lives. But innovation and instability often look the same in the moment. The difference only becomes clear in hindsight. Right now, the system is stable. Default rates are low. Banks are profitable. Consumers are getting rewards. Sole proprietors are funding their hustles. Everything works until the moment it doesn't. And when that moment comes, the people who will suffer aren't the banks. They'll get bailouts, they'll restructure, they'll be fine. It's the millions of Americans holding business credit cards for businesses that never quite materialized, who will wake up to higher rates, closed accounts, and debts they can't discharge in bankruptcy the way they could with consumer cards. The question isn't whether you can legally qualify for a business credit card as a sole proprietor. You can. Question is whether you should. Whether you understand what you're agreeing to when you click Submit. Because somewhere in America right now, someone is filling out that application, typing in a business name that doesn't exist, estimating revenue they haven't made, clicking through terms they haven't read, and in 60 seconds, they'll be approved. And everything will be fine until it isn't.